Today, March 16th, 2026, a man who runs a company that used to sell business intelligence software woke up, opened his laptop, and spent $1.57 billion before most people finished their morning coffee. $1.57 billion in Bitcoin. 22,337 coins, purchased at $70,194 each in a single transaction, announced with 2 words on social media: stretch the orange dots. That's it. No press conference, no congressional testimony, no explanation offered to the financial analysts who have spent the last 6 years telling their clients that Michael Saylor is insane. Just stretch the orange dots. His name is Michael Saylor. His company is STRCG, formerly MicroStrategy, formerly a mid-sized software company from Tysons Corner, Virginia, that nobody outside enterprise IT had ever heard of. And the question this video exists to answer is not whether Michael Saylor is crazy. The mainstream financial media has been asking that question since 2020, and they have gotten the answer wrong every single quarter since. The question is this: if Michael Saylor is right, if his framework for understanding Bitcoin as the only functional monetary technology that survives the collapse of the current dollar-denominated financial system is even partially correct, what does that actually mean for the price of a fixed supply digital asset that now has 761,068 coins sitting on a corporate balance sheet? The answer is not complicated. Bitcoin explodes. But the mechanism, the precise causal chain that connects Saylor's thesis to a price outcome that makes every prior Bitcoin bull run look like a warm-up exercise, that is what most people watching this channel have never had explained to them in the language of macro finance, institutional positioning, and the mathematics of fixed supply assets meeting forced monetary expansion. That is what this video does. By the end of the next 30 minutes, you will understand exactly why Michael Saylor has been buying Bitcoin every single quarter since August of 2020. Why he has never sold a single coin, why his company now holds more Bitcoin than any other publicly traded corporation on the planet, and why, if his analytical framework is correct, the price of Bitcoin in the next 4 years makes everything that has happened before it look like a rounding error. Look, before we continue, let me make this clear. Obviously, this video is not financial advice. I'm sharing my vision and strategy, but you are the CEO of your own capital. Never risk money you cannot afford to lose, as the markets are engineered to be volatile. Do your own research, keep your emotions in check, and only play the games you are prepared to win. Now, let's get into the dat. Let's start with what happened today, because today is not normal. You need to understand what strategy actually is before you can understand why today's purchase matters. In 1992, Michael Saylor founded MicroStrategy to sell business analytics software to enterprise clients. He built it into a respectable company. He took it public. And then in 2020, during the most chaotic monetary environment in modern financial history, he made a decision that the financial establishment treated as evidence of a clinical break from reality. He converted his company's treasury from cash to Bitcoin. Not partially, not as a hedge, not as a speculative allocation in a diversified portfolio. He converted the entire corporate treasury to Bitcoin, announced publicly that he intended to continue buying Bitcoin with every dollar of free cash flow the company generated, and then, when he ran out of free cash flow, he began issuing equity and preferred stock to raise additional capital specifically to buy more Bitcoin. The financial media's response was unified and unambiguous. This man has lost his mind. CNBC anchors questioned his fiduciary responsibility to shareholders. Wall Street analysts downgraded the stock. Fund managers who had never read a word of Saylor's technical writing on Bitcoin issued lengthy reports explaining why his strategy was reckless, short-sighted, and financially illiterate. And then something happened that the financial media has spent 6 years declining to fully acknowledge. Let me be precise about what explodes actually means, because precision matters here more than excitement. Saylor's public price targets are the following. In the short term, 2026, $150,000 to $444,000. He has stated this range in multiple public interviews and has not backed away from it, even as the price has experienced significant volatility. In the medium term, 4 to 8 years, $1 million per Bitcoin. This is his most widely cited target and the one that generates the most media attention, primarily because journalists who have not read his framework present it as an eccentric prediction rather than a mechanistic consequence. In the long term, by 2045, $21 million per Bitcoin. This is his maximum scenario, the scenario in which Bitcoin captures a meaningful portion of the global store of value market currently held in gold, real estate, and fiat currency reserves. These numbers are large enough that they trigger a psychological response in most people that prevents serious analysis. The response is, that cannot be right. And the response to that response is, the same thing was said at $500, at $5,000, at $50,000. Let me give you the arithmetic that makes $1 million not a prediction but a structural consequence. Total global wealth is approximately $450 trillion. Gold's market capitalization as a store of value asset is approximately 15 to 18 trillion. The dollar-denominated bond market is approximately 50 trillion. Global real estate is approximately 300 trillion. If Bitcoin captures 5% of the global store of value market, not 5% of the cryptocurrency market, 5% of all the wealth that human beings hold in forms intended to preserve value across time, that implies a Bitcoin market capitalization of approximately $22 to $25 trillion. 25 trillion divided by 21 million coins equals approximately $1.2 million per Bitcoin, 5%. That is Saylor's $1 million target, expressed not as a prediction, but as a market share number, 5% of global store of value. In a world where BlackRock has a Bitcoin ETF and Abu Dhabi holds Bitcoin, and MICHAEL Saylor controls 3.6% of the supply. Does 5% seem unreasonable? Gold currently holds approximately 4% of global wealth as a store of value. Bitcoin, with fixed supply, global digital accessibility, ETF infrastructure, and a structural correlation to the monetary expansion that is going to be forced by a $38 trillion debt load, Bitcoin holding 5% of global store of value wealth is not a maximalist fantasy. It is arithmetic. Saudi Arabia's exploration of digital asset exposure, reported in financial intelligence circles, follows a logical chain that Saylor identified years ago. The Petrodollar system, oil priced in dollars, dollar earnings reinvested in U.S. treasuries, structural demand for dollar assets, is the foundation of the dollar's reserve status. The moment Gulf states begin pricing oil in alternative currencies, accumulating gold and Bitcoin reserves, and reducing their treasury holdings, the structural demand for dollars falls. The Federal Reserve becomes the buyer of last resort. That means more printed dollars, more liquidity, and every dollar of additional liquidity is a dollar searching for a store of value in a world where the primary alternative, dollar-denominated assets, is what that liquidity is trying to hedge against. Iran, operating under the most comprehensive sanctions regime in financial history, has developed Bitcoin mining operations as a mechanism to convert stranded energy assets into a globally liquid, sanctions-resistant store of value. Russia, before 2022, moved the majority of its sovereign reserves into gold and yuan-denominated assets. China has been accumulating gold at record pace for 3 consecutive years. These are not retail investors making speculative bets on Bitcoin's next halving cycle. These are sovereign actors making strategic decisions about how to hold value in a world where the US dollar's role as the neutral reserve currency is being actively contested. The smart money in the geopolitical context was positioning years before the scenario became consensus. That is always how it works. Saylor positioned strategy before BlackRock built a Bitcoin ETF. BlackRock built a Bitcoin ETF before sovereign wealth funds disclosed holdings. Sovereign wealth funds disclosed holdings before retail investors fully understood what the institutional accumulation implied for the price. The question for the person watching this video right now is not whether to believe Saylor's framework. The question is, at what point in the institutional positioning sequence are you? Because there is a sequence. And the people who position before the sequence becomes consensus are the ones who capture the asymmetric return. Second, something better comes along. Bitcoin gets replaced by a superior monetary technology. This argument has also been available since 2009, and it has not happened. Every alternative has either been less decentralized, less secure, or less fixed in supply. The network effects of Bitcoin, the liquidity, the custody infrastructure, the ETF ecosystem, the institutional familiarity, compound every year. The moat gets wider, not narrower. Third, the correlation to liquidity breaks. Maybe the historical relationship between monetary expansion and Bitcoin appreciation was an artifact of early market conditions and does not hold at scale. This is a serious empirical question. It is also the one that Saylor would answer by pointing at today's purchase and saying, "We will find out together." Saylor's phrase is exact. There is no second best. Not second best among cryptocurrencies. Second best among all monetary assets. If you are looking for a store of value that is fixed in supply, globally accessible, impossible to confiscate, without controlling private keys, and structurally independent of any government's fiscal decisions, there is no second option. Gold is close, but it is not fixed. Gold supply grows at approximately 1.5% per year. Miners will produce more gold if the price is high enough, and central banks hold gold in custody that is theoretically subject to confiscation. Bitcoin has none of these vulnerabilities. There is no second best. Here is the part of the Saylor thesis that most retail investors miss, because most retail investors are focused on the Bitcoin price chart and not on the institutional positioning that precedes the Bitcoin price chart. The institutional accumulation that drives Bitcoin's next major price movement has, in significant part, already happened. BlackRock accumulated Bitcoin ETF assets faster than any ETF in history. The rate of inflow in the first year of the Bitcoin ETF exceeded the inflow rate for gold ETFs by an order of magnitude. The people moving that capital are not retail investors buying from their Robinhood accounts. They are institutional allocators making deliberate, analyzed decisions about portfolio construction in an environment of dollar uncertainty. Abu Dhabi's Mubadala has publicly disclosed Bitcoin ETF holdings. For context, Mubadala manages approximately $300 billion in assets. The disclosure of Bitcoin ETF exposure is not a speculative bet. It is a sovereign wealth management decision made by people who understand that if the dollar's structural trajectory is what the numbers suggest, holding $300 billion primarily in dollar-denominated assets is precisely the wrong position. This is not a normal market dynamic. There's no analog in financial history for a publicly traded company systematically removing fixed supply units from circulation at this scale and announcing its intention to continue indefinitely. Saylor has a target. He has not stated it precisely, but the arithmetic of his purchasing rate and his publicly discussed ambition suggests a goal of 1 million Bitcoin before the end of 2026. He currently holds 761,000. He needs to acquire approximately 239,000 more. At current prices, that is approximately $16 billion in additional purchases. He has already announced the mechanism. STRC, Strategy's preferred stock instrument, allows the company to raise capital specifically to buy Bitcoin without diluting common equity in a way that destroys shareholder value. Because the Bitcoin per share metric continues to increase even as total shares outstanding grow. The mechanism is self-reinforcing. The more Bitcoin Strategy holds, the more credible the company's Bitcoin Treasury thesis becomes to institutional investors. The more credible the thesis becomes, the more demand there is for STRC. The more STRC capital strategy raises, the more Bitcoin it buys. The more Bitcoin it buys, the higher the price, the more valuable the existing holdings, the more credible the thesis. This is not a Ponzi scheme. Saylor has addressed this directly and correctly. A Ponzi scheme requires new investors to fund returns for existing investors. Strategy's mechanism does not require Bitcoin's price to go up for the company to create value. It requires only that Bitcoin per share continues to increase, which it does mechanically every time the company buys more Bitcoin using equity instruments that expand the share count by less than the proportional increase in Bitcoin holdings. But here's the question that Saylor's framework has always rested on, and that his critics have never satisfactorily answered. If Bitcoin is not going to $1 million, if Saylor's thesis is wrong, what is the mechanism by which a fixed supply asset with global liquidity, ETF infrastructure, sovereign wealth fund exposure, nation-state accumulation, and a structural correlation to monetary expansion fails to appreciate in an environment of forced monetary expansion? There is no clean answer to that question. The bears have three arguments. First, regulatory risk. A government could ban Bitcoin. This argument has been available since 2009, and it has not happened in any major economy. It has not happened because the economic cost of a unilateral ban, the capital flight, the competitive disadvantage relative to jurisdictions that do not ban it, the impossibility of enforcement against a decentralized network, exceeds the benefit for any rational government. And with BlackRock and Fidelity and Abu Dhabi holding Bitcoin, the political cost of a ban in the United States has never been higher. Coinbase Institutional's liquidity tracking framework finds correlations approaching a 0.9 across most time horizons. Bitcoin is the most liquidity-sensitive asset on the planet. This is not a Bitcoin maximalist claim. This is an empirical observation made by quantitative researchers who do not have a position in Bitcoin. Now, apply Saylor's framework. If the structural trajectory of U.S. government debt is what the Congressional Budget Office says it is, and there is no credible analyst who disputes the CBO's numbers, only the timeline, the Federal Reserve's response to a debt load that cannot be serviced by the tax base is not ambiguous. More liquidity, more balance sheet expansion, more quantitative easing, whatever name you want to apply to the process of creating dollars to buy the bonds that fund the spending that the tax base cannot support. In 2008, the Fed's balance sheet was under $1 trillion. In 2022, it touched $9 trillion. A doubling of the current balance sheet from $6.5 trillion to $13 trillion would, based on historical correlations to Bitcoin's price behavior, produce price appreciation that makes the 2020 to 2021 bull run, the one that took Bitcoin from $5,000 to $69,000, look modest. But here is where Saylor's specific contribution to this framework becomes analytically important. In 2020, when Bitcoin went to $69,000, the institutional infrastructure for Bitcoin exposure was primitive. There were no BlackRock ETFs. There was no Fidelity Bitcoin fund. MicroStrategy had just started buying. The marginal dollar entering the Bitcoin market was primarily retail. Today, the infrastructure is completely different. BlackRock's Bitcoin ETF has accumulated tens of billions in assets under management. Fidelity has a competing product. The ETF infrastructure means that institutional capital that previously could not hold Bitcoin directly due to regulatory or fiduciary constraints, can now flow into Bitcoin with the same ease as buying a treasury bond. Saylor's company, STRCG, has developed what he calls a Bitcoin yield metric, essentially the rate at which Bitcoin per share is increasing as the company continues to issue equity and preferred stock to fund purchases. The BTC yield year to date in 2026 is 1.2%, meaning shareholders of STRCG are accumulating Bitcoin exposure at a compounding rate that is explicitly designed to outperform holding cash. The 761,000 coins that STRCG currently holds represent approximately 3.6% of all Bitcoin that will ever exist. 3.6% of a fixed supply asset held by a single corporate entity that is publicly committed to buying more every quarter forever. Before we get into the specific mathematics of what Saylor's framework implies for Bitcoin's price, and I want to be precise about this, because the numbers are genuinely extraordinary, I want to take a moment. If you have made it this deep into this analysis, you are officially in a very small minority of people who take their financial education seriously enough to sit through the mechanism rather than just the headline. Most of the internet would have stopped watching when I started talking about the debt to GDP ratio. You did not stop. That is not nothing. Because we are talking about money and global financial architecture today, I want to know who is in this community. Drop a comment below with your city, your local time, and what the weather looks like where you are right now. Genuinely, reading where this community watches from is one of my favorite parts of making these deep dives. Tell me where you are. While you're down there, hit the like button and make sure you are subscribed. Your engagement tells the algorithm that there is an audience for serious financial analysis that doesn't talk to you like a child. Now let's get into the math, because the math is where this gets interesting. Let me give you the number that makes Saylor's framework not just plausible but mechanically compelling. As of today, the Federal Reserve's balance sheet sits at approximately $6.5 trillion. In 2020, the Federal Reserve expanded its balance sheet by nearly $5 trillion in approximately 2 years in response to COVID. Bitcoin, during that same period, went from $5,000 to $69,000. The correlation between that balance sheet expansion and Bitcoin's price appreciation is not coincidental, and it is not subtle. It is the most reliable single macro predictor of Bitcoin price behavior that quantitative researchers have found. Dr. Michael Howell of Cross Border Capital, tracking global liquidity across nearly 90 countries, has documented a correlation between global M2 growth and Bitcoin price appreciation that runs to 0.78 in the 2020 to 2023 period. In a world where every other monetary asset is subject to supply expansion by the institutions that control it, Bitcoin is the one asset where supply is fixed, forever, regardless of what any government, any central bank, or any financial institution decides. That is Saylor's thesis, not Bitcoin as a speculation. Bitcoin as the only functional monetary technology for a world in which the alternative, holding assets denominated in currencies controlled by governments with $38 trillion in debt, is a guaranteed path to purchasing power destruction. Now, is this framework correct? The answer matters enormously. Because if Saylor is right, even partially, even approximately, even directionally, the implications for Bitcoin's price are not incremental. They are exponential. And here's where most Bitcoin analysis breaks down. Most people, when they try to evaluate Saylor's thesis, ask whether they believe it. They treat it as a matter of faith, of risk tolerance, of personal financial philosophy. Saylor does not ask whether you believe it. He points to the institutional positioning that has already occurred and asks you to explain it by any other mechanism. BlackRock, managing $11 trillion, does not build a Bitcoin ETF because they find the technology interesting. They build a Bitcoin ETF because institutional demand from their clients, endowments, sovereign wealth funds, pension managers, family offices, has reached a threshold where declining to offer Bitcoin exposure is a business risk. Abu Dhabi's Mubadala does not disclose Bitcoin ETF holdings as a philosophical statement. They disclose Bitcoin ETF holdings because the people managing that sovereign wealth fund have run the same analysis Saylor ran in 2020 and reached the same conclusion about what the dollar's trajectory means for a portfolio primarily denominated in dollar assets. Saudi Arabia, according to financial intelligence reporting, has begun exploring digital asset exposure as a diversification tool. In a world where the Petrodollar, the system that requires oil to be priced in dollars, creating structural global demand for dollar assets, is under increasing pressure from alternative payment systems, holding the majority of sovereign reserves in dollar-denominated instruments is precisely the wrong position. These are not ideological conversions. These are the decisions of sophisticated institutional actors who have looked at the structural trajectory of the dollar, the arithmetic of the US debt load, and the availability of a fixed supply asset with global liquidity and ETF infrastructure, and concluded that diversification into Bitcoin is not speculation. It is risk management. The question Saylor asks, and it is the right question, is not whether you believe Bitcoin will go up. It is why you would believe that the institutions managing the world's largest pools of capital are making a mistake. Michael Saylor has given hundreds of hours of public interviews, written extensively on Bitcoin's monetary properties, and articulated his thesis with a level of technical precision that most of the journalists covering him have never bothered to engage with. Here is the thesis, compressed to its essential structure. Every monetary asset in human history has eventually been debased. Gold was hoarded by governments and its convertibility was revoked. Silver was demonetized. Every fiat currency ever created has experienced significant inflation over its lifetime. The dollar has lost more than 96% of its purchasing power since the Federal Reserve was created in 1913. This is not a conspiracy theory. This is arithmetic. Central banks create money to finance government spending. Government spending in a democratic system expands because the political incentive is always to spend more and tax less and borrow the difference. The debt grows. The interest on the debt grows. At some point, the debt load becomes large enough that the only politically viable response is monetary expansion, creating more currency to service obligations that the tax base cannot support. We are at that point. The United States currently carries $38 trillion in federal debt, 121% of GDP. Interest payments on that debt exceed $1 trillion annually, more than the defense budget, more than Medicare, more than any other single line item in the federal government's accounts. By 2030, the Congressional Budget Office projects interest payments will exceed $2 trillion annually. By mid-century, debt to GDP approaches 250% in the baseline scenario, the scenario where nothing goes catastrophically wrong. In that environment, holding cash is not a neutral decision. It is a decision to watch your purchasing power erode at whatever rate the Federal Reserve determines is politically necessary to service the debt. And the Federal Reserve's primary tool for managing that debt load is the same tool it has always used, creating more dollars. Saylor's insight, and it is genuinely an insight, not a slogan, is that Bitcoin is the first monetary asset in human history where this dynamic cannot apply. There will only ever be 21 million Bitcoin. That number is not a policy decision subject to reversal by a central bank under political pressure. It is not an agreement between governments that can be renegotiated when the fiscal math stops working. It is a mathematical property of the protocol, enforced by a decentralized network of nodes that no government controls and no legislature can override. Michael Saylor was right. Not right in the way that someone gets lucky on a speculative bet and then pretends they knew all along. Right in the structural, mechanistic, analytically defensible sense that his framework for understanding what Bitcoin is, not a cryptocurrency, not a speculative asset, not digital gold, but a fixed supply monetary network that operates outside every jurisdiction and cannot be debased by any central bank, predicted the behavior of every major market participant who came after him. BlackRock built a Bitcoin ETF. Fidelity built a Bitcoin ETF. Abu Dhabi's sovereign wealth fund, Mubadala, disclosed Bitcoin ETF holdings. Nation-states began accumulating Bitcoin as a reserve asset. And Michael Saylor, the man who started buying at an average cost of $25,000 per coin, now sits on 761,068 Bitcoin with an average acquisition cost of $75,696. He is not selling. He has never sold. He has said in public, on the record, with the specificity of a man who has thought about this for 6 years, we are not going to be selling. We are going to be buying Bitcoin every quarter, forever. Let that word sit for a moment, forever. That is not the language of a speculative trader managing a position. That is not the language of a hedge fund building a thesis with a defined exit. That is the language of someone who believes, with the conviction that only comes from deep structural analysis, that the asset he is accumulating is not going to be replaced by anything else, ever. And that the monetary system that currently makes cash look like a reasonable alternative is on a path of irreversible degradation. Now, is he right? That is the question worth 3 hours of your attention. But we are going to answer it in 30 minutes. And we are going to answer it not by asking whether Michael Saylor is a visionary or a lunatic. That debate is settled by the chart, and the chart does not require your opinion. But by asking what the specific mechanical consequences of his framework being correct actually are. Because there is a difference between believing something and understanding why it is true. Saylor believes Bitcoin goes to $1 million. A lot of people believe that. The people who matter are not the ones who believe it. The people who matter are the ones who can explain in mechanistic terms why that price outcome is not a prediction, but a mathematical consequence of a set of structural conditions that are already in place. That explanation is what the next 20 minutes builds. The question is timeline, not destination. And on timeline, today's purchase is the data point. Saylor said he would buy every quarter forever. Today is March 16th, 2026. He bought 22,337 Bitcoin, $1.57 billion, before most people finished their coffee. Forever means every quarter. This quarter happened today. The pattern has not broken. The thesis has not changed. The accumulation continues. Now, in the interest of intellectual fairness, a standard the mainstream financial media has not applied to MICHAEL Saylor for the last 6 years, but let us apply it here anyway. Let me address the bear case. The bear case for Bitcoin is essentially, Saylor is wrong and the financial establishment is right. The financial establishment's record on this specific question is as follows. In 2020, when Saylor bought his first Bitcoin at $25,000 average, the establishment said, "This is reckless, this is a breach of fiduciary duty, this will destroy shareholder value." The stock went up, the Bitcoin went up. In 2021, when Bitcoin hit 69,000 and then corrected to 16,000, the establishment said, "We told you so, it is over, the bubble has burst, Saylor is finished." Bitcoin subsequently recovered, surpassed its prior all-time high, and Saylor bought more at every price level. In 2022, when the entire crypto market collapsed in the aftermath of FTX, an event that had nothing to do with Bitcoin's monetary properties and everything to do with a fraudulent exchange, the establishment again declared Bitcoin dead. It was not dead, it recovered. New all-time highs followed. The establishment's prediction record on Bitcoin over the last 6 years is, to apply a precise technical term, catastrophically wrong. But the bears do have one argument that deserves serious engagement. They argue that the correlation between monetary expansion and Bitcoin appreciation is not guaranteed to hold at the scale that Saylor's thesis requires. That as Bitcoin's market capitalization grows to trillions of dollars, the marginal impact of additional liquidity decreases. That the asymmetric upside available at a $100 billion market cap is structurally different from the upside available at a $10 trillion market cap. This is a real concern. It is also the concern that Saylor addresses directly and correctly. The mechanism that drives Bitcoin from its current market capitalization to the store of value market capitalization, implied by his thesis, is not retail speculation. It is institutional reallocation. It is sovereign wealth funds that currently hold $300 billion in dollar assets deciding to allocate 5% to Bitcoin. It is central banks that currently hold gold deciding to hold Bitcoin alongside gold. It is pension funds responding to the demand of their beneficiaries who have watched every other asset class inflated away and are asking for exposure to the one asset that cannot be inflated. The marginal buyer at $10 trillion is not a retail investor trading from their phone. The marginal buyer at $10 trillion is a sovereign wealth fund making a portfolio allocation decision. And sovereign wealth funds move slowly, deliberately, and in size. The purchase today, $1.57 billion in a single transaction, is not a retail event. It is a demonstration of what institutional scale accumulation looks like in practice. One transaction. 22,000 coins, $1.57 billion. Before lunch. Scale that up to a sovereign wealth fund with $300 billion in assets deciding on a 5% allocation, $15 billion, 10 times Saylor's purchase today, in a single allocation decision. That is the marginal buyer at $10 trillion market cap. That is not speculative demand. That is institutional reallocation at a scale that the current Bitcoin market has never absorbed. And Saylor has been building the infrastructure for that absorption since 2020. There's a phrase Saylor uses that the financial media treats as evidence of irrationality. 0 or 1 million, no middle ground. They hear this and they think, this man is a fanatic who cannot conceive of a moderate outcome. He is binary where the world is continuous. He is extreme where reality is nuanced. They have misunderstood the claim. Saylor is not saying Bitcoin will definitely reach $1 million. He is saying that the structural conditions that would produce a middle outcome, Bitcoin at, say, $200,000 forever, never going higher and never going to zero, do not exist. Here is why. If Bitcoin is a valid store of value, if the monetary properties that make it attractive at $100,000 make it attractive at $200,000, then institutional demand will continue to allocate to it until it reaches a market capitalization consistent with its share of the global store of value market. The dynamics of institutional reallocation are self-reinforcing. As more sovereign wealth funds hold Bitcoin, the risk of not holding Bitcoin for a sovereign wealth fund that holds none increases. The career risk for the fund manager, who is not in Bitcoin while every peer is in Bitcoin, exceeds the career risk of being in Bitcoin when the price corrects. The institutional adoption dynamic, once initiated, does not plateau at an arbitrary price. It continues until Bitcoin holds a market share of the global store of value, market consistent with its monetary properties relative to alternatives. That market share number at current global wealth levels implies a price well above $1 million. Alternatively, if Bitcoin is not a valid store of value, if the institutional adoption is a bubble, if the monetary properties that Saylor has documented are not real, if the correlation to monetary expansion is an artifact that will not persist, then the institutional capital that has already accumulated will eventually liquidate. And the liquidation of institutional capital from a fixed supply asset is not a moderate correction. It is a cascade. Those are the two scenarios: massive appreciation driven by structural institutional demand, or collapse driven by institutional liquidation. What is not a scenario is Bitcoin sits at $200,000 for the next 20 years, while everyone watches it doing nothing. 0 or 1 million. Not because Saylor is a fanatic, because the dynamics of institutional adoption of a fixed supply monetary asset do not produce stable intermediate outcomes. This is not optimism. This is game theory. Applied to the structure of a fixed supply asset, meeting mandatory institutional reallocation in a world of forced monetary expansion. There's a dimension of Saylor's current thinking that most financial coverage of his Bitcoin thesis has missed entirely, and it is potentially the most important one for the next decade. Let me close with a specific statement that Saylor has made publicly on the record, that the mainstream financial media has spent 6 years declining to take seriously. He said, "You know, there is a delay between the time we buy the Bitcoin and the time Bitcoin goes to the moon." This is not a boast. It is a mechanistic observation about how institutional accumulation of a fixed supply asset produces price outcomes. When Strategy buys 22,000 coins in a single transaction, as they did today, March 16th, 2026, those coins are removed from the liquid market. They go onto a corporate balance sheet with a public commitment to never sell them. The float of available Bitcoin contracts, the next buyer must purchase from a smaller pool of available coins at a higher price. The delay Saylor refers to is the lag between the accumulation and the market's recognition of what the accumulation implies for future supply. Markets are not instantaneous. Institutional accumulation happens before retail recognition. The price moves after the positioning, not during it. He bought at 25,000. The price went to 69,000. He bought through this correction to 16,000. The price went to 73,000. He bought today at 70,000. You're watching a video about where it goes next. Here's the data you need to make your own decision. 761,068 Bitcoin. 3.6% of total supply, held by a single entity that has publicly committed to buying more forever, against a backdrop of 38 trillion in US government debt growing at a rate the tax base cannot service, against an institutional adoption curve that has accelerated from 0 to BlackRock, Fidelity, and Abu Dhabi in 5 years, against an AI-driven compression of terminal value for alternative stores of value, against a fixed supply of 21 million coins that no central bank, no legislature, and no artificial intelligence can increase. If Saylor is right, even partially, even directionally, even on the timeline measured in years rather than quarters, the math is not subtle. The question the mainstream financial establishment has spent 6 years failing to answer is not whether Saylor is crazy. The question is why they are still holding cash. If you're still watching this video right now, I want you to understand something. You just made it through 40 minutes of macroeconomic analysis, institutional positioning data, fixed supply mathematics, and a complete breakdown of a framework that the majority of the financial world still refuses to take seriously. Most people clicked away at the debt to GDP ratio. A large percentage left when the institutional adoption sequence started. A meaningful number exited during the game theory section. You are still here. That means something. Comment below with 3 letters. I see the diamond. Not because it is a secret code, not because it gets you anything, but because I want to know exactly how many people in this community have the patience, the discipline, and the intellectual appetite to sit through the mechanism rather than just the headline. I see the diamond is what you say when you understand that the value is not in the price chart. It is in the framework. It is in the structural analysis that explains why the price chart looks the way it does and where it is going next. If you got here, you got it. Subscribe if you are not subscribed. The algorithm buries channels like this one because serious financial analysis does not generate the dopamine spike of a 10-second clip. Your subscription is a signal to the algorithm that there is an audience for work that treats you like an adult. And share this video with one person who is still holding cash and telling themselves they will figure out Bitcoin later, because Saylor just bought 22,000 more coins this morning, and he has never been early.